Welcome to the deep dive. Look, you're here because you want to get a better handle on market trends, right?
Mhm.
And today we're aiming to give you a tool for just that. Forget scrolling endlessly, forget all the conflicting stuff online. We're focusing on how trading indicators can, well, maybe offer a clearer view.
Yeah, a potentially smarter way to look at the markets.
Exactly. Our goal isn't to just, dump a load of info on you.
No, definitely not. It's about pulling out the key bits, the insights that might actually, well, help.
Which is why we're doing a deep dive today into Keltner Channels. We've been looking at this really quite interesting YouTube video from Top Dog Trading. It breaks down this trend trading strategy.
Yeah.
So what we want to do is kind of get under the hood. How do these Keltner channels actually work? What are the signals telling you about potential trades, especially in strong trends?
Right. And importantly, how are they different from, say, Bollinger Bands? That's another one people hear about a lot.
Exactly. Think of this as getting the essentials, without spending hours digging through it all yourself.
Okay, sounds good. So, Keltner Channels. Let's start with the basics. What are the actual components? What makes them up?
All right, let's break it down. The video highlights three main things. First, you've got that line in the middle.
Mm-hmm.
That's a 20-period exponential moving average, an EMA.
Okay, 20 EMA. So like a moving average, but it gives more importance to the newer prices.
Yeah, exactly. It kind of smooths things out, but reacts a bit quicker than a simple moving average. Gives you a snapshot of the immediate trend, more or less.
Got it. And then there are the lines above and below that middle line, the bands.
Right, the upper and lower bands.
Now, these aren't based on standard deviation like some other indicators, are they? What drives these?
That's a really key point the video makes. These bands use something called the average true range, ATR.
ATR.
Yeah. And in the specific example they use on TradingView, it's an ATR with a length of 10, and they multiply that value by 2.
Okay, so 10-period ATR times 2. What does that actually, represent on the chart?
Well, think of ATR as measuring the recent average true range of price movement, how much it's typically moved, day to day or bar to bar, including gaps.
Right, it's volatility in a sense, but measured differently than standard deviation.
Exactly. So the Keltner bands take that average wiggle room over the last 10 periods, double it, and plot that distance above and below the 20 EMA.
So the EMA is the center line, and the bands show sort of a typical range around it based on recent movement.
Pretty much, yeah, like the typical lane the price has been trading in recently.
Okay. And that 20 EMA, the middle line, the video mentioned it, can be significant on its own, right? Like during retracements.
Yeah, that's interesting. They suggest it can act as a kind of dynamic support or resistance area.
How so?
Well, imagine you're in an uptrend. Prices are generally moving up. If the price pulls back a little, it might find support. Buyers might step in right around that 20 EMA.
Okay. So it acts as a potential reference point within the trend.
Exactly. And the flip side for downtrends, the video even suggests it could be used as a potential trailing stop.
Right. So if you're long and the price breaks decisively below the 20 EMA.
Yeah, that could be a signal that maybe the uptrend's losing its momentum. Might be time to think about getting out.
Makes sense. Okay, so we have the components 20 EMA, middle line, ATR-based, upper and lower bands. How do we use these channels to actually spot trends, specifically those strong trends the video talks about?
Okay, this is where it gets practical for trading. The video lays out a very specific condition for identifying the start of what they consider a strong trend.
And what's that condition?
It's about the price touching one band, let's say the lower band, and then, crucially, moving across and touching the opposite band, so the upper band in this case, for the very first time.
The first time. They really stress that part. Why is that so important? Just touching the opposite band isn't enough.
Right. They make a big deal about it being the first time. The idea, I think, is that not all trends have strong momentum. You want to catch the ones that are really starting to move with conviction.
Yeah.
So if the price has just been shopping around between the bands for a while, touching one, then the other might not mean much. But that initial break from one side all the way to the other for the first time.
That suggests a shift, like real directional energy is potentially building up.
Exactly. It's like seeing that first powerful waveform after a period of calm or just ripples. That first touch across the channel is the signal they look for, suggesting a stronger trend might be kicking off.
So to be clear, price touches the lower band, then moves up and hits the upper band for the first time. That signals a potential strong uptrend starting.
That's the idea, yes.
And conversely, if it touches the upper band, then drops and hits the lower band for the first time, That's the signal for a potential strong downtrend.
Got it. That's the core concept for identifying the start of these stronger moves according to this strategy.
Okay. Now, the video also mentions, maybe just briefly, what to do after you get that signal in terms of actually entering a trade.
Yeah, they touch on that. They have their own specific market entry indicator, which, is their proprietary thing. But the general idea they suggest
Uh-huh.
is not necessarily jumping in the second price hits that opposite band.
Oh, okay. So wait a bit.
Yeah, they suggest maybe waiting for a little pullback, a retrace. After that initial signal hits, the thinking is you might get a better entry price.
Right. Rather than chasing it right at the high of that initial surge or the low of the initial drop, trying to be a bit more strategic on the entry.
Exactly. It's about potentially getting a slightly better price after the initial signal confirms the potential trend.
Makes sense. Okay, now another big comparison point in the video was Keltner Channels versus Bollinger Bands. They look kind of similar in a chart sometimes.
They do, yeah. Both are envelope-style indicators around a moving average. The video even jokingly calls Bollinger Bands Bollinger Bands.
Right. But they're fundamentally different in how they're calculated.
Totally different. That's the main takeaway. We just talked about Keltner channels using the average true range, the ATR, to set the bandwidth.
Based on that recent average movement range.
Right. Bollinger Bands, though, they use standard deviations.
Standard deviation, so that's measuring volatility based on how far prices are spreading out from the average price.
Precisely. Typically, it's 2 standard deviations above and below a simple moving average, usually a 20-period one.
So Keltner is about the average range of movement. Bollinger is about the statistical deviation from the average price. 2 different ways of looking at price behavior.
Exactly. And because they measure different things, the video shows how the lines they used, blue for Keltner and black for Bollinger, often won't match up.
Yeah, they'll track differently.
One isn't better necessarily, they just give different information. A key thing with Bollinger Bands is they'll actually widen when the market gets really volatile.
Right, because the standard deviation increases.
And they'll narrow or squeeze when volatility dries up. Keltner channels, using ATR, tend to be a bit smoother, maybe less reactive to sudden spikes in volatility compared to Bollinger Bands.
Okay, that distinction is clear. Keltner, ATR average range, Bollinger standard deviation volatility.
Yep.
And this difference leads into that bonus tip they offered, using Bollinger Bands for potentially exiting trades.
Yeah, that was a neat little idea at the end. It offers a different perspective on managing exits.
How does that work, using Bollinger Bands to get out?
Well, the logic goes like this. Bollinger Bands are set usually at 2 standard deviations away from the mean, the moving average. Statistically speaking, price spending a lot of time outside those bands is relatively uncommon.
Okay, it's like an extreme move, statistically.
Right. So the suggestion is if you're in a trade, say a long trade, and the price pushes strongly above the upper Bollinger Band, instead of waiting for it to pull all the way back to maybe the Keltner 20 EMA, you could consider taking profits there when it's making that statistically extreme move outside the Bollinger Band.
The idea being that such a move, driven by high volatility, has a lower probability of just continuing indefinitely. It's more likely to snap back.
That seems to be the reasoning, yeah. You might capture more profit before a significant pullback happens, potentially.
So it's a more proactive exit strategy based on volatility extremes compared to, say, waiting for the price to break back below the Keltner EMA, which is more reactive to the price action itself.
Exactly. 2 different philosophies for trailing stops or taking profits. One based on average range, Keltner EMA, the other based on statistical volatility, Bollinger Bands.
Interesting. So let's kind of wrap this up, Keltner Channels. We got the 20 EMA, the ATR-based bands. Key signal for a strong trend starting is that first touch of the opposite band.
Right. That's the core of the strategy presented.
And they're fundamentally different from Bollinger Bands, which use standard deviation, measure volatility, and will expand and contract with market conditions.
Correct. Different calculations, different information.
And that bonus idea, maybe using those Bollinger Bands, those volatility extremes, as a potential signal to lock in profits, perhaps earlier than just waiting for a trend structure like the EMA to break.
Yeah, a different tool for a different job, potentially helping optimize exits based on statistical likelihoods.
It really highlights how different indicators can offer unique perspectives on what the market's doing.
Absolutely. So here's something to chew on, something for you to think about. Given that Keltner channels look at average range and Bollinger Bands highlight volatility and standard deviation, How might you potentially combine insights from different types of indicators like these, indicators that measure unique things about price action? Could layering these different views give you a richer, maybe more nuanced, and potentially more profitable understanding of market trends?
Yeah, it's that idea of not relying on just one thing, right? Seeing the market through multiple lenses.
Exactly. Something to consider as you develop your own approach.